Hello traders, welcome to this session. In today's session I'm going to be recapping some trades I took into the New York close on the RTY. Then once the Globex market opened, I then was trading the 2-tick ES chart. So we'll be looking at there's no videos here, that is I'm not playing back the trades, but I just thought that'd be really good to go back over the charts and to recap why did I take them, what did I see, what's the syntax, the order of things that I'm looking for. So it was 12 trades for 11 wins and 1 loss. I'm just looking at the ES right now. In fact, let me just pull this down for you. Okay, so I'll pull this down. So what can we see right here in front of us? Well, what we can see is the flow of the river, if you like, or the tide. We can see that we've got trending EMAs, and that's one of the advantages when we use Renko charts. Yes, we lose some information from the charts, but we gain a lot more as far as smoothing out price action. And you can see here that I've got my trigger line. See that white line and the arrows? That's my turning point indicator, and also the super scalper. In some ways they do the same thing. The trigger line of a turning point, the arrows, which works with the trigger line, will get you usually in slightly earlier, but we want to be trading in direction of a trade. Now, just so you know, if you're new to trading, each one of these little steps you can see here on the Renko chart is worth $12.50. Okay, so here we had a bounce there. You've got that's called a 3B. This is a 34B. That's what we call a T10. That's an overshoot. These are all patterns, and once you understand how to trade patterns, it makes it so much easier. And as humans, we are very good at identifying and learning patterns. So let's get into this, and I'll then go over the charts with the trades taken. That is some screenshots, then we'll go to the charts themselves. I want to keep this under 30 minutes. First of all, traders, we do know there's a risk in trading. Don't trade with money that you can't afford to lose. Stay on the simulator, and that's until you're consistently profitable. And that's one of the great things about trading platforms today. You can trade on the simulator until you're ready to go live, and even then consider starting on the micros. Now, as Mark Douglas stated in his book, it was around page, I think it was page 273 or whatever it is, when he was giving advice on how to master the art of day trading, he said to become an expert, choose a simple trading system that identifies a pattern. So you get to know a visual representation of the market, and that's really what I'm looking for. I'm looking for a flow. I get really frustrated if ever I've got a choppy market. That's not for me. Now, you know, some traders are really good at trading ranges. That is not me. I prefer to just to sit on hands. I want to see trending EMAs. So if you like, I'm trading in the direction of a higher time frame. I actually use what we call an entry chart, which is a lower time frame. I'm looking for a retracement on the lower time frame, then a trend continuation in the direction of the higher time frame. Then I'll have my divergence trades. I love trading divergence, but I've been trading 28 years, so I'm pretty good at it. However, if you're a new trader, you really want to really stand aside from divergence trading initially. It really can be, it's tricky, and it can be hypnotic. That is, you can be looking for that market to change, you can be looking for the reversal, yet you've got a strong trending day, and even sometimes I get caught up with that. So you've got to be really careful there. Now, by the way, you can, in the description link below, if you're watching this on YouTube, you'll be able to actually download this spreadsheet where you can play around with the figures, and I've got a little training video that goes with this. So by all means, yes, you can download some of my free ebooks, but also this spreadsheet, which will allow you to plan ahead a realistic trading plan. Show me a man or a woman that's got a compelling future, and I'll show you someone that will master the art of day trading. But we also need to be realistic. That is, I never risk any more than, well, in my case it's 1%, and I won't get into that now. For most traders it's 2%. That's mighty fine, but as you build your account, if you want less stress, 1% is better, much better. You see, ultimately you're running your own hedge fund. That's what it really comes down to. You're running your own fund, and so you want to keep that risk level down. Now that gets easier perhaps as you get older and as you have the funds to do that. So I recommend here that you would start with 4,000. You're never risking, that's if you're trading the 4-tick Renko. My apologies, I should have mentioned that. So here today on the New York close, I'm trading the 4-tick Renko chart on the RTY on the Russell. The 4-tick works an absolute treat. Okay, it's a beautiful chart. It's just, it plods along really nicely. Now sometimes it's too fast. Well, that's when I'll then increase the time frame, and that's the other thing too. The time frames I'm using here are subject to the market conditions. Okay, for an example, I'm going to be showing you how I trade a 2-tick Renko chart. Now that's okay during quiet market times, near impossible during the New York morning unless you're scalping and just using market orders. That's not for me. Generally you'd be trading a 4-tick during the New York hours on the ES. Horses for courses. Now if you're a new trader, once again, once you get training on this, it's really straightforward, okay, on how we choose the right time frame for that time of day. It's easy. But here, by netting $200 a day, you got the potential there within 12 weeks of a $10,000 a week income. This is a reality if you trade patterns, if you go with the flow of the ocean, of the tide, of the river. Okay, this is a true reality. Now I believe in POQ, power quitting. That suits me. I'm 65. I don't want the stress. I want to get in, get out, get paid, and wrap it up. But if you're a young gun, or perhaps you're quite happy to keep trading, you go for 300 a day, which is not which is extremely reasonable when you're trading on a normal day and with training and experience. And by the way, of course, these are projections. I've got to be careful what I say, but here, if you've got a 16-tick stop, you can see where you are in 8 weeks. Now down here I state trading 10 contracts. You've got no problems trading 10-20 contracts at a time during the New York hours on the RTY. It's a different story during the Globex session after hours. Okay, so the market closes at 4 p.m. Central, reopens at 5 p.m. Central, and that's called the Globex session. Goes right through the Asian session, London, then into the New York session. It's thinly traded. Now as you head towards a London session, which is 1 a.m. 2 a.m. open Central Standard Time, the volume picks up. Before then, from say 5 p.m. Central up to say midnight, if you're trading 10-15 contracts, you get slippage, and that is you're not getting the price you wanted. You can still trade it, but it's just not as good as the New York afternoon. Now perhaps it's too much information for newer traders, but it's important you get these little tidbits. Now on the ES, likewise on the RTY, I didn't show you the micro contract, but if you're going to trade the ES is of course a lumbering giant, typically 1.5 million contracts a day, tons of volume, basically 23 hours a day. Now if you're going to trade, and what your stop loss comes down to is once again where you place your stop, which I'll show you in a moment. But if you're going to trade, you really need around the 6,300. Now I know what you're thinking, well hang on, my broker says I only need 1,000. Yes, that's true, but what if you have a 10-tick stop loss on a big contract? That's $125. There's 12.5% of your capital gone. Remember, we never ever risk more than 2% unless you've got a fantastic strategy system and you're consistently profitable. I'm not saying that there's not day traders out there that have a high risk parameter, but what I'm talking about is the average profitable trader is they understand that it's money management. So if you don't have the 6,300, start on the micro, which is 10% of the value. Here, going for $32 a day, within 12 weeks you've now got 7,400 potentially, and now you can roll over and start trading the big contract. Okay, and so risking no more than 2%, $125. Okay, you've then got within 11 weeks there a potential there of earning over your $10,000 a week. You've got $56,000 in capital. That's on basically $313. In fact, it's normally I talk about $312.50 to be exact with my members, which is, what was that, 26 ticks. Oh, there it is there. Yes, 26 ticks a day. Now what's our plan of action to achieve that? And this is important. So if you want to scalp the market, I'm a scalper. Get in, get out, get paid. But also it means I've got a smaller risk. I don't hold positions, nothing overnight. Most of my trading's over and done within 30 minutes to an hour. That suits me. If you're going to scalp, for an example, just here, if you go for 5-6 tick trades a day, okay, here that's 350 after your commissions and after any losses, naturally. So it comes down, so I'm just looking at a couple of the setups here right now. Yes, your risk might be 8 to 10 ticks in risk, but that's where you can also go for a larger target. It really comes down, and I won't get too much into that, it just comes down to the quality of the setup and your risk parameter. For an example, the steeper the EMA bounce, that you've got an EMA bounce, and providing you got some angulation and not too much, you'll see this in a moment, okay, you can really just scalp like this all day, every day. But look, it's better if I show you on the charts. It's going to be a lot easier. So these are the important levels that we're looking for. Now, thanks to modern technology in virtually every trading platform, these will plot automatically. By the way, I know the lighting's not the best here. I've had people improve your lighting. Well, I'm not a professional, whatever you want to call it, so you'll have to excuse me if the lights aren't bright enough here. I just remembered someone emailed me and said you need to put more light on yourself. Never mind. Anyway, where are our pivot levels? Where are the prior open, high, low, and close? Our major EMAs, intraday swing highs and lows, and the current day's high and low. Now let's just quickly review these charts, and we'll go to the ES chart. So this was in the afternoon, so this is at 2:43 Central Standard Time. What you've got to watch as you approach 3 p.m. I usually don't do any trades after 3 p.m. Central Standard Time. It can get really fast. So up here, this is what I call a T3. It's a reversion to the mean trade, very high probability, works brilliantly on most markets. It's just a great setup. Okay, thank you very much. Now I should say a couple of these trades here I only picked up, it was on the ES. Actually on the ES I only picked up a couple of ticks on each, but you'll see that in a moment. So here, nice winner. Then I jumped in on this one, and with this one it was quite a late entry. I actually should have been in here, and I exited down here at the major EMA. See that blue line and these blue lines? These are what we call pivots. So we tend to bounce a lot of pivots. It was trade number 2. This is what I call a 3B. I took that there and jumped out of that. I then shorted here, thank you very much, and I got out just down here. Why did I exit here? Why did I exit over here? Because you can see I've got a pivot below and a major EMA, and we tend to bounce. Now if I had stayed with that trade, it would have been mighty fine, but I prefer to look at a re-entry, get out, cover any risk, pick up a few ticks. Now with this one, this was actually a mistake. When I say mistake, it wasn't a mistake within itself. As far as a trade, it was a nice winning trade. I got in a little bit too early. I should have been in over here, and so I don't know what I was thinking, okay, at the time, but I jumped in, and a couple of seconds I thought, oh shoot. Okay, now when I'm trading this market, I've got a 16 tick stop. So when I enter a trade, I like to see my stop 1 tick above, 1 tick above, 1 tick below, 1 tick above, one tick above, okay, with my type of setups that I trade. So here it actually went against me 10 ticks. So I got in here and I thought, fruitcakes, I'm in too early. Then it rolled over and still filled me. Now, why take this trade when I'm hard up against the pivot? Because effectively I'd been making lower highs. Okay, so it's like a descending triangle. So so I decided to jump in, and a nice little trade all over in 10 minutes, 5 for 5. So thank you very much. Let's now just have a look at the ES. Now the ES was this evening, well, actually last night. I'm recording this 31st of March, and so just here there were some beautiful trades, as you'll see when we go to the charts in a moment. Yes, still got time to do that. If I was trading, it would have been a beautiful trade. That's what I call a pivot magnet trade. We had then a beautiful T3, nice divergence trade as well. Trade number 2 down here. I then entered this particular trade. I really should have been in up here. I took this and I covered at the 2. I only picked up a couple of ticks out of this. And why did I cover down here? Well, you can see we did bounce, and eventually went down a little further and bounced, and then we were rejected. Whenever you're selling into or buying into major EMAs, particularly for the first or second time, you tend to bounce off those. So they're a lower probability trade. So I covered when I come down and hit the major EMAs. Okay, I then where are we here? Oh yes, then I took this one just here. Right, I went long up to the pivot and covered, and this was a silly trade. Okay, so with this one I only picked up a couple of ticks out of that one. This one just here, I should not actually 25 20. Do you know what? That was actually a break even. I didn't realize. So just there, that was actually a break even. You'll have to forgive me. Okay, that was actually a 50, yeah, it was. So that was actually a break even trade. So I apologize, everyone. I was saying that I had that was actually should be 5 wins, 1 break even, 1 loss, but a break even's better than a loss, isn't it? Now this was actually a silly trade. Why was that a silly trade? I was looking at the divergence that I had. So you can't really see it down there, but I had divergence down here. But what was going against me was I had very strong uptrending EMAs against me just here. Okay, and I remember I went into the green down here thinking, you know what, I should be out of this. I shouldn't have taken this trade, and I stayed with it, got a full stop out. So it was just a silly trade. And that's the thing, traders, we've got to think, when we're trading, it's not rocket science. Anyone can basically learn this, and I should have known better on this one, because what I was doing was selling into strong uptrending EMAs, and I bounced straight off it. Okay, and so that was should have been a beautiful long. Okay, so that should have been a long I should have taken every day of the week. And the reason I covered on this one, okay, and I thought it was a little winner, but in fact oh look, I picked up on 5 lots there. I did pick up 1 tick. All right, so after commission, still a winning trade, but just okay. So I treated it as a pivot magnet trade. Now if I had have stayed with that and kept my stop 1 tick below, I would have been okay entering here. But at the time I had divergence, I jumped in, and I shouldn't have been in on this one. And I remember what was happening here. That's right. Excuse me one moment. We actually had a cyclone go through 3 weeks ago, and we got flooded through our roof. A heap of rain come through, and I had the mold, because we've got mold in the rooms. I got to replace the ceiling in half of our house, and that was when the guy was driving up the driveway. And so, not want to blame, but it's what was happening at the time. Okay, so but I still shouldn't have been. I was looking out the window. But traders, the thing is, when we make a mistake, and this is the difference between winning traders and losing traders, we have to apply what we call black box thinking. That is, if we make a mistake, we've got to view it. Now, that was a silly mistake, and yep, I was distracted, so I shouldn't have taken the trade, but I did. I had divergence, didn't think it through fully, still took the trade. Okay, what can I learn from this? It's no good, yes, I was cross at myself at the time, but what can we learn? This is what we call black box thinking. This is why at the end of each day it's important that we go back and analyze, what trades did I take, what didn't I take, why didn't I take that trade, or why did I take that trade? This is a business, a very profitable business, and it ain't rocket science, but we've got to sometimes sit back. Okay, now with this trade here, this is where I entered. Now, was it on this video? I think it was, that I said I only risk 1%. I never ever have any more than 2% risk in any one position in my account. So just here, I shorted 1%. What it means is I can also enter, either add to a winning trade or enter again if I've got a very high probability trade. So I shorted here. Where was my stop? One tick above. Then I had a beautiful double top with divergence. It was actually, for members watching, this was a 2D. It went up there and tested my stop to the tick. Then I re-entered at exactly the same entry price. Okay, and so I had a double position, and thank you very much. And for members watching this, we could have even shorted again here with our T10 just there. Then we had another potential short there, but I'd hit my target all over in 30 minutes. So let me just quickly go to the charts here, and let's have a quick look at the charts. Okay, so this is what we're looking at. So on the way up, you had a potential trade there at 17.18. You had another one there. See the trigger line? See how that's black? That's saying do not go long here anywhere. Okay, here you can stay with the trade. You can actually use the trigger line to stay in a trade if you wish, and you can adjust the length of that. Okay, so here you had a number of potential entries. Now you'll see me quite often doing this on my charts, and what I'm doing when I'm doing that, I'm looking to see whether there's any pivots in front of me. And the reason for it, we've got a setup called the pivot magnet trade. Now the pivot magnet trade is very rules-based, but it works an absolute treat. Very high probability trade. So that was the first trade there I took. Okay, now up here I then had a mean reversion trade. Right, I did have some divergence, but it was reversion to the mean. But let's just quickly scoot along here, because I want to show you what happened afterwards, because a lot of traders will say, now what about these ones on the way down? I'd already taken that one. I really should have entered here. But when you're selling down into a major EMA, get ready for a bounce. Now up here I then roll over. I then had another potential entry just there. Now why was that a potential entry? Well, look at my EMAs thundering down. See the orange cloud? Okay, and so I had another potential entry there. Down we come again. Now as we're coming down like this, this is where then I want to check what's happening on the anchor chart. And this is one of the best, well, I don't want to say best kept secrets. Okay, I don't really want to say that, but by looking at your higher time frame, see the trigger line, that black line just here? That's telling me I can keep taking all of these shorts down here. Okay, now eventually it's going to turn. I mean, it's still slightly lagging, but it's based on square root numbers, and it turns very, very quickly. Like, see that just there? I've now got we call that a T10, by the way, a T10 in the direction of a trigger line on my anchor chart. And see this one just here? Okay, so I've now got an EMA bounce just here, and down we go again, and I've got a T10, and down I go again. Now all of these traders are patterns. So to truly succeed, and look at this just here, Do you know what this is? This is called angulation, by the way. Very simple concept. Bill Williams, the late Bill Williams, he wrote the book New Trading Dimensions and the book Trading Chaos. He was really the grandfather of trading using fractals. And something I learned from many years ago was the power of angulation. Angulation generally means we've got a very strong uptrend. Now at the moment, see just there, we are at the high of day. And so usually when we've got massive angulation, and for members watching, we've got a T3 on both the EC and the anchor chart one. This is where generally then we're looking for a potential reversal, and quite often we don't even have divergence. So when you've got massive angulation, you can get some great reversal trades, especially if it's on multiple time frames. So the markets are what we call fractal in nature, and if you've got reversals on multiple time frames or angulation, the market can't continue like it. It's got to pull back. It's called a fractal point. Okay, so very soon, quite possibly, of course we can, what's the time here now? In 8 minutes it's nearly 5 p.m. so we've got it's nearly 2 a.m. Central Standard Time. So what that means is, traders, it's nearly 8 a.m. in London. So 8 a.m. in London is when the market opens. It doesn't open at 9, it opens at 8. I think because of the Europeans, a lot of the European countries are an hour earlier. So we'll probably find here you don't want to be in a position. I do not recommend you're in it. And here's your T3. Now just as I'm telling you about this may not come off. You've got to believe and trade in probabilities of 20, but this is a typical T3 reversal. Now what I was about to say though, in 7 minutes the market will probably go crazy. I don't want to be in an open position at the market open. I call the London Open and the New York Open the killing field. It's very easy to be smashed or hammered in the first 15 minutes. So I've actually just paused this for a moment. I'm going to pause it for a bit longer as well, just so you can see. We'll see what happens, and I'll turn it back on so you're not going to lose any time. So I'll pause it again. I just want to see if we get a retracement here. So as I mentioned, this is a T3, but we are now only 5 minutes to the London Open. So once again, getting right into the open or straight after, it's a time to sit on hands. So I'll just pause this video again. So it's still just ticking around here, so you can see it's slowed right down as we're going into the London Open. So this is what I mean about trading around the open. Now quite possibly we could spike up, or we could drop down. So always be careful of market opens. But look, we will stop just there. What you've got to be very careful of whenever you see this massive angulation, okay, we're usually heading towards a pullback. In fact, this is called a zero lag MACD. MACD, that's actually a MACD BB, but just there, if it's just changed a little bit, this here is a zero lag MACD, as this one is. Very sensitive. But see how price action is potentially rallying still to the long side, but see how low the MACD is down here. What's that tell us? Not only do we have a lot of angulation just here, but we've also got a lot of divergence setting up. In fact, look, I will finish it. Look, we're at 30 minutes, but what I'd be looking for here, just subject to what the market thinks in a couple of minutes at the London Open, but that's the making. Now let me expand this for you. That's the making of a really good potential divergence trade. Okay, that's generally what I'd be looking. See that there? Okay traders, look, we will finish there. If you are watching YouTube, if you haven't subscribed to my channel, please do. Make sure you keep updated. Of course you can click on the link below. It's down there somewhere if it's on YouTube, where you can download one of my manuals, and also the spreadsheet there, just on, and you can see this here. Now when this candle closes just there, so this is an official, I call this still, it's as good as a double top. looks like a duck, quacks like a duck, it's a duck. And see that divergence just here, traders? See that there? So this is what I mean about the divergence. Now this is on the ES. Now remember, 8 ticks here is worth $100. Okay, so here pulling, it's not quite, it's about to turn 8 o'clock. And let me actually pause this for a moment. See, we're pushing down. So there's your divergence trade I mentioned a few minutes ago. Okay, so now we've got the open. Now that actually ticked down and touched. Now that's there, it's just a lot of data coming through. So that's actually come down and touched 7 ticks, which is 87.50 per contract. So see what I mean about the open? So this is at 2 a.m. So you just want to be very, and you've got greater divergence here again, whether or not it'll pull back. And see that just here, a lot of divergence. Now when we've got divergence, we're usually looking for price action to pull back here, but once again, and you can see why we bounce off it. So so we usually look for it to pull back. But traders, we are at 31 minutes. Just so you know, I do run a live trading room and I run live coaching classes, so why don't you come along and join me and I'll teach you how to scalp and day trade the markets. Thanks traders, see you on my next video.